There will be a presentation by the Department of Revenue, and then the testifiers in order. Commissioner Markwood. The way we're going to proceed, members, is article by article, and as we get the review of each article, that will be the time when questions are appropriate. I think that was your request. Is that correct,
Great.
Commissioner?
That would be great, Madam Chair.
Okay, thank you. All right, you may begin.
Well, thank you very much, Madam Chair, members of the committee. I am Paul Marquardt, Commissioner of the Department of Revenue, joined here at the table by Joanna Bears, Legislative Director. And a big thank you for the committee in hearing Senate File 2374. And a big thank you to you, Madam Chair, for authoring the governor's tax bill. So
And I am going to stop you now. We have indeed achieved a quorum. So if you let me just take care of this one piece of business. We have the minutes from March 18th, 2025. Are there corrections or additions? Seeing none, the minutes are approved as presented. And since also we have achieved a quorum, I have some apologies to make for mistakes I've made yesterday. As most of you know, one of the rules that we follow in this committee is not to hear bills with 5 authors of the same party. It was not up to Senator Draheim to inform me that there were 5 authors on his bill that were Republicans. We heard the bill. I went back when I found this out yesterday afternoon. I went back and checked the bill as introduced, and indeed there were 5 signatures on it. It was not someone that was added, so I apologize for that, and I will apologize to Senator Draheim. We're also going to hear a bill tomorrow in balancing things out that has 5 DFL authors on it. So I hope I don't make that. We weren't aware of that at the time either. We know it now. We're going to let both of those bills go forward, and the one yesterday, of course. And I hope I don't make that mistake again, but I apologize. So now, Commissioner Markwood.
thank you very much, Madam Chair. And I want to again thank you for authoring the governor's and lieutenant governor's tax bill. So I'm very pleased today to talk about Senate File 2374, which is Governor Walz and Lieutenant Governor Flanagan's tax portions of their budget. And in light of the tight budgetary times, I think the governor's proposal here is very responsible and very practical, has some very strong goals. One is to look at a more fair and more stable tax system. There's a number of provisions in the tax bill that promote economic development and will create jobs. Another important area, it also addresses some important kind of issues that have been out there the last couple years on a bipartisan basis that we think needs to be addressed and solved. And as brought up in the last meeting, the governor does ask local government, counties and cities to help share in solving this structural imbalance. And he does it in a way, though, that protects those essential and really important services like public safety. So with that, I'd like to start here. And a big part of the governor's budget, the last thing I'll say generally, is that the goal for the governor is to solve 1/2 of the 28-29 structural imbalance. And right as of the November forecast, that was 3.5. So this current budget solves about 1.75 billion of it. We know that went up to about 3.9, and the governor's supplemental budget, which will meet those same goals, will be coming out soon. So with that, moving to Article 1, and as Madam Chair mentioned, I'm going in the order of the bill. And I know I was here before to talk about the governor's bill here. We can get maybe a little more detail, maybe a little less in some cases, but we'll go in order of the bill. So Article 1 is the Sustainable Aviation Fuel Policy and Funding Changes. The language here is identical to Senate File 1312 as amended that you heard already in this committee. So it adds funding. It will have a supplemental credit of 2 cents per gallon for every 1% over the 50% of carbon reduction that can be made. And then it also makes some changes on what qualifies kind of for the use, and they add gas carbon oxides. Don't ask me exactly the details on that. But this sustainable aviation fuels is huge. And we know in Moorhead, as mentioned when the hearing was heard on Senate File 1312, that DG Fuels is looking at a multi-billion-dollar plant in Moorhead that will create 650 jobs and produce about 193 million gallons of SAF. So this is a huge economic driver and very important to all areas of the state. So that is Article 1, and very excited about that. Another is the repeal of the K through 12 education credit assignment. We've talked about this one before. The K through 12 education credit is not changed. The only part in here is there is an assignment where if a person can assign their up to $1,500 credit to a lender, that part is taken out. And less than 1% of everyone who was using this credit actually did the assignment. So that part and that part only is being taken out from the K through 12 education credit. Next part is Governor is very excited about this part, expanding the research and development credit. The governor's been talking to a lot of businesses, and what the governor heard time and time again was this is a top priority, the research development credit. What this does is it makes it refundable up to 25% of any excess R&D credits that are there. As part of the bill, it addresses a 2017 OLA report that addresses some weaknesses in the bill, in that program. This helps address that by requiring a report looking at what is the effectiveness of the credit. And so the next slide, please. So again, it's trying to keep Minnesota as a leader in business innovation and R&D development. Minnesota was the first state in the nation to come up with an R&D credit in 1981. And quite frankly, we need to step that up. We need to increase the growth of research and development. This credit will help do that. It's about $20 million a year is what that is, the tax cut. And on the average, it will present each corporation pass-through entity about $33,000 of a tax cut. That currently isn't there. So it'll help about 500 corporations and about 100 pass-through entities. And folks sometimes look at the R&D credit and they only look at it in terms of jobs. But it's a lot more than that, because if you are doing research and development, you never fully as a business appreciate all the benefits of what it's doing for society. I mean, so you look at all these medical inventions that have taken place that really improve the quality of life, and the R&D really doesn't ever kind of capture that for the business. And the second thing is, too, that others can copy that invention over a period of time, too. So it's more than just jobs. It's creating, just the way R&D works, it's creating incentives to actually want to do that R&D credit. So we think this is really positive. The next is kind of maybe a leftover from the last couple years, the short line railroad, and that, of course, provides a 50% income tax credit for any reconstruction and replacement on a track. This allows a person to transfer that credit immediately rather than waiting till the end of the tax year. And that is Article 1, Madam Chair. If there's any
Thank
questions.
you, Commissioner. Are there questions or comments relative to Article 1? Okay, thank you very much, Commissioner. You may
Thank you, Madam Chair.
proceed with Article 2.
Thank you, Madam Chair. Article 2, this is an increase to the state airport fund, or actually the airline flight property tax. And so there is a state airport fund, which consists of about 4 different revenue sources. And what it does, it provides for infrastructure improvements for airports around the state. And the fund right now with these 4 different revenue areas is about $26.7 million. And part of it, one of the 4 funds, is this flight property tax on airlines, basically all their property, wealth, and so forth. And what it does is, because this 26.7 is kind of set, is that the $7 million that right now goes into it kind of goes up and down based on the other 3 funds. So if the other 3 funds are short, then that will increase. If the other 3 funds are more, it goes down. So it's kind of coupled to this 26.7. This decouples that airline flight property tax away from those other 3 funds, and basically just, instead of $7 million, sets a permanent levy at $8.05 million. And the main idea is that they're looking to increase this the state airport fund by about 10%, by a total of about $2.6 million, and about $1 million of it is in this property tax. So they just decoupled it, add $1,050,000 to the levy, and then that would be set at that point. Next is everyone's favorite here, attachments and appurtenances. We now use the term distribution systems instead of attachments and appurtenances. That's going to include metering and street lighting and smart meters and all of those things. And we're hoping we can get this one across the finish line this year. Next, this one is as a result of the Alliance case, which said that an institution of purely public charity would be exempt from any property taxes. So the way the law works right now is that if you have property that is exempt like this, that the tenants have to pay a personal property tax, and at market value. And you might say, well, why would there be a silly law like that on the books? Well, take the University of Minnesota, which is not taxable, but you might have a Caribou Coffee there that you wouldn't want to be tax exempt. Or out at the Minneapolis-St. Paul Airport, you've got a McDonald's there, you wouldn't want that to be property tax exempt. So what this does is, without any change, you're going to have these tenants in these places that would have to pay this pretty strong tax. So all this does is eliminate the fact that they would have to pay the tax. It makes no other changes, no rate changes or anything like that, but it just protects the tenants and the renters of these facilities from paying a personal property tax. Next one is reducing aquatic invasive species aid, which right now is a set amount at $10 million a year. This would reduce that to $5 million a year. And that's Article 2, Madam
Okay,
Chair.
questions or comments? With regard to the tax on airline companies, they're already paying it. Is that in terms of your explanation? And this is just leveling it out at a higher figure. Is that correct?
Madam Chair, that's exactly correct. It's usually right around 7 million, but it can go up or down. This will just set it at a fixed rate.
And so, Commissioner, when you say airline companies, we're talking about every single airline company, not just the big international ones. Is that correct?
Madam Chair, that would be correct.
Okay. And with regard to Section 3, how is the eligibility for the renter's credit affected by Section 3?
Oh, Madam Chair, on the Alliance, that area?
Yes,
Yes. So, Madam Chair and members of the committee, as a tenant, you would not qualify now for the renter's credit.
Would not qualify,
Right,
but you
because there'd
also
be
would
no
not be,
tax.
but you would not be paying this personal property tax. So
That's
it's-
correct.
Okay,
So there'd be
which,
no-
if we look at the, if we look at the revenue estimate, Commissioner, it shows a modest impact by doing that on the PTR, and a slightly in the negative, and then in the positive on income tax.
So, Madam Chair and members, that $10,000 on the property tax refund interaction would be, there would be a shift because there's no property tax now being paid on these properties. There'd be a shift onto other properties,
Onto
which would
other
increase the
properties.
homestead credit state refund.
And with the property tax refund, with the income tax refund, that is the impact on the renter's credit. Is
So,
that,
Madam Chair, what that would be is now taxpayers would not have a deduction on their taxes, on property taxes, so that would increase revenues coming in.
increase revenue
Yeah, that's it.
because of the loss of the renter's credit to them, but also no responsibility to pay the personal property tax.
I- Madam
Just want
Chair, I
to make
believe
sure
that's-
that
that's right.
I'm tracking that correctly. Thank you. Any other questions, comments? Senator Weber, thank you.
Thank you, Madam Chair. As you recall, the last time the commissioner was here, I and he had an exchange about property taxes as it relates to other parts of the governor's budget and the shifting of responsibility on to particularly the counties. And I was just, to follow up on that point, do you have an estimate today, Commissioner, as to how much additional money is going to be proposed to be shifted onto the shoulders of our counties as a result of the governor's budget?
Madam
Commissioner.
Chair and Senator Weber, I have met with the county folks and been given some numbers. I have not actually received official numbers from those, MMB and that. But I would say it's, north of $100 million for sure, so.
Okay, okay.
And, I mean, I hate to give a number right now just because I haven't seen from MMB what that number is.
Okay, all right. Well, thank
Senator
you,
Weber.
Madam Chair and Commissioner. I just, I always have a bit of an issue, having been in local government, with the state transferring its burdens onto the shoulders of local government when they actually did nothing to create the problem in the first place. But that's all I'll say on that issue for now, Madam Chair.
Thank you, Senator Weber. Anyone else? Senator Drazkowski.
Thank you, Madam Chair. Thank you, Commissioner. Commissioner, when will you or MMB be able to provide us with that number? It seems to me this is a governor's proposal. It's been out for, a couple of months now, or 6 weeks, or something like that. I would expect that the administration would know what that is. And then the other question, Commissioner, you mentioned when you were beginning to discuss this, that you were going to ask counties to accept some of the responsibility. Is it ask or tell?
Commissioner?
Madam Chair and Representative Drazkowski, I think as the governor has a budget, he's looking for everyone to share in on this. And whether someone would see that as an ask or a tell, I think might be in the eye of the beholder. But on the first point, on the numbers, I'm sure the numbers are there. And I apologize, I just didn't ask for those numbers on what it is that the county share might be now as in solving this budget deficit. But we certainly can get that to you. But I'm sure the numbers are there. I just didn't ask for them to get them for this presentation.
Senator Drazkowski, as you were posing your question, what I heard was don't ask, don't tell.
That might be the governor's strategy, Madam Chair. I don't know.
Whatever.
You know, it sure could. But Madam Chair, I don't think the counties, and Commissioner, I don't think the counties will have a choice if this passes into law. And so it appears that state government would tell the counties that you're going to do this rather than ask. But I look forward to that summary too, and I would hope that it doesn't take super long. Thank you, Mr. Commissioner.
Anyone else on Article 2? Article 3.
Thank you, Madam Chair and members. So Article 3 is the sales tax proposal. This is a long overdue improvement to the sales tax code. And so I'm going to kind of talk about this, talking about the cutting the rate and then get into the expanding the base. But what this does, which is always good policy, is it expands the base and cuts the rate. And just looking at the benefits of doing this is you have better fairness for consumers and businesses. I mean, we already tax a number of services. And why are we picking winners and losers in doing this? We're right-sizing the economy. Back in 1967, when we first, Minnesota was one of the last states, by the way, second to last state to pass a sales tax. But when we did, it was at 3%. But about 60% of the economy were goods and 40% were services. That's pretty much flip-flopped today. And what that equates into is a narrower base and higher rates. We know the sales tax is a stable revenue source, more so than income tax or corporate tax. And we also have strong evidence that by adding services to the sales tax, it does lessen or make more progressive the sales tax. So with that, let's look at lowering the statewide sales tax rate. So the rate cut is 0.075, which is actually on the 6.5, is to the 6.425 in parentheses there, because you've got the legacy 0.375. That's what most people will see is that cut. Be the first sales tax rate cut in the history of the state. The rate cut is about a $99 million cut in fiscal year 27. That's the first full year of it. That's why I'm using that number. What's really important is there's no business-to-business sales taxes here. And that's important. So if you've got a farm operation and you hire an accountant to do your books, that is not taxable. Because if you are engaged in income-producing activities, that's a business, and those aren't taxed. So the next point is, and I'm going to talk a little bit more about individuals later, but individuals and businesses will get a tax cut. And some of the data, as you can see here, an average family, that's probably about $120,000, $130,000 income, will see about a $37 cut. And from what I'm going to, some of the data now that we have on this, I was asked from the committee here to find data. And so research has looked at the best they can. But I think we can safely say that a large majority of individuals will see a sales tax cut under this proposal. And at $37, basically, if you spend $550 or less on any of these expanded services, because at $550, 6.8% is $37. So if you spend $550 or less, you're going to see a tax cut. If you spend $550 or more on these expanded services, you would see an increase in taxes. And of course, if you don't spend anything at all, you've got a tax cut also. But I can get into that a little bit more later. But businesses, this is important. They will see a sales tax cut on all of the purchases that they're currently paying taxes on. And so, materials, supplies, and equipment for a construction project, right now, those are all taxable. General items, as I list there, all taxable. Construction, if you're building a house, lumber is taxable. You're now going to see a tax cut on that sales tax. But all the equipment, bulldozers, excavators, all those huge equipment, you would see as a business a sales tax cut. It's, we're focusing a lot of individuals, but because we're not doing business to business, the governor's plan does not have business to business sales taxes here. Those things the businesses are currently paying taxes on, we'll see a tax cut. So let's move to the next one. So these are services currently taxed. And the reason I want to show this gets to a little bit of certainly the fairness question I mentioned, where, these folks are already being taxed. But when you get to services, it becomes a little more nebulous in what is taxed and what is not taxed. You got an appliance here, a dishwasher, whatever, that's pretty clear cut. But with services, and I think from testifiers, you'll hear a lot of questions. What's taxable, what's not? And that's fair. And it's nothing new to the Department of Revenue. When the Department of Revenue went through all these services, it was the same type of questions. And if you've ever gone onto our website, you will see where they will have sales tax fact sheets, literally A to Z. And you can just take B and go to one type of business, and you've got pages on how that applies. So this bill does not make the sales tax, when you look at services, any simpler. Let's put it that way. But it's something the Department of Revenue has done for many, many years, and through revenue notices and fact sheets, we get to what's taxable and not taxable. So I know that's going to be a concern from folks, but it's nothing new. And as testifiers come forward today, we're listening. I mean, there's no vote being taken on this bill today. This is something really serious that we really should be thinking about. And if it's exactly this way, I don't know. But the governor's really serious about making this system fair and more stable. And, we're open, the governor's open to suggestions as we move forward, and we can exclude things and so forth. So just know that we're very open to that. And so the next slide then is the expansion, right-sizing the economy to a more service-oriented economy. And as you look at these kind of three main areas, accounting, banking, and brokerage, and legal, basically, yeah, they look kind of general. What I have here is what is actually in the bill. But unless something is excluded, what I would suggest to you is just assume that it's taxable. Unless it's specifically excluded, just assume that's probably taxable. But I will say that just because it is taxable doesn't mean a business does tax it. So I want to give you an example. I looked at my own bank in Dilworth, and I looked at its fees and so forth. And so I get free checking. Free checking, ordering, free debit card, free money orders, cashier checks, notary, fax, and photocopy services. On savings account, there's no annual fee. There is a required balance of $100, and there is a $10 monthly fee if the balance dips below that minimum. But free ATM cash card, free bill pay. So even though some of the things I just listed are on this list, doesn't mean a business taxes them or needs to tax them. And I will suggest that if there is a sales tax applied to fees, businesses may look at, as far as competition, whether or not I should be charging a fee on that service or not. And it may actually have businesses taking a second look, especially if another entity is not doing that. So these are the areas there. So when you take off the business-to-business taxes, you're left with actually a smaller portion of the pie, because most of it is in the business-to-business. But you have probably 4 main areas of consumer services that are not currently taxed. Professional services like these are one. And the other one is personal consumption, haircuts, so forth, funerals, and then automobile repair and maintenance. And if you look at these other 3, other than professional, those are going to be those that are going to be used a lot more. And as you're going to see here with some of the, as I explain some of the data, like legal service and that, very specialized as far as the number of people that will use that as far as households. So I want to move to the last slide. Oh, and so the total increase on the expansion, and you heard me say the 99 million on the cut. The total overall increase in 2027 is 215 million, which is about, expands the sales tax base about 2.6%. So let me get to the very last one here. Services excluded from the sales tax exemption. There it is, tax preparation, those claiming the working family credit, child tax credit, banking, loan origination fees, overdraft, late fees, management defined benefit, pension plans, legal aid services. But so here's, I asked, because you had asked, so I asked our research department to see if they could figure out exactly what percent of the individuals with this would see a tax cut versus a tax increase. And the modeling they use is a kind of a very broad economic sweep. So they can't get down to the kind of the granular level of an exact percent. But here's what they did give me, and that they know off of their modeling. So they didn't use an average family. They used the average household, which is a little less income, probably 100 to 110. And they said that person would receive an average tax cut of $32. Overall, the general tax increase would be about $72. But 60% of that is legal aid. So if you take legal aid out of the mix, and right now you've got $99 million of cuts, 215 million of increase. But if you take, if you take legal services out of the mix, that subtracts 125 million. So you now have the increase of 90. So, and the analysis says that less than 10% of all the households will use legal services. So let's just take legal services, and we'll say that anyone who uses legal services will pay more. So let's just put 10% right there that will pay more. All of the rest is you have the $99 million cut, and in the banking and brokerage and accounting, you have a $90 million increase. On the average, all those other taxpayers will see a tax cut, $9 million. And bringing it down to this person who's seeing this $32 cut, all of the ones other than legal, it's a $31 expansion on all the other 3. So you're seeing a $1 cut. But about 25% will use accounting, about 25%. And so and that's only one of the remaining left. So let's say you used all the remaining ones, and at most that'd be like 25, let's say 30% that are using all the other ones. And let's just split it down the middle and say half are spending more than that medium, the other half spending less. You probably have maybe 15% now that are paying more, and 15% out of that paying less. The bottom line is you probably have about 20 off this data. you probably have 25%, roughly, assuming that everyone who takes legal is paying more. You probably have 25% that's paying more, and probably 75% that is paying less. Now, that's my conclusion off the data, not House research. But the data would lead to
Senate-
those
Or
conclusions.
Senate fiscal.
But I'm sorry, Madam Chair.
You referred to House research, but we look to Senate
Yeah,
fiscal.
no, right, in the data we have here. So I think it is safe to say, and I could put this on paper, and it's tough to explain, I know. But from the data we have, that I think it's very safe to say that a large majority of individuals, based on the usage of these select services, would see a tax cut under the governor's proposal here. And I think that's important. And the last thing is the sales tax proposal budget impact. There's 185 million net over those 2 years, and in 28-29, it's 235 million. And just to put that in perspective, of the governor's initial budget, he has, for 28-29, $8 of budget cuts to every $1 of revenue increase that's in this tax force. So it's 8 to 1. And also, it would be effective for sales and purchases made after September 30th of 2025. So I know that's kind of the big part of the bill, but that's Article 3.
Commissioner, there were two other sections in Article 3. Did you want to briefly?
Oh, yes, that is on the cigarette tax and,
Yes, sir.
yeah, so all.
And the lottery.
And the lottery,
tickets.
yes. Madam Chair and members, all that is doing is right now, that is fixed. It's related to the sales tax rate. And because we're changing the sales tax rate, but we're not changing the legacy or cigarette tax, we have to put those percentages specific in the statute. And Madam Chair, that's a great point. This has no impact on the lottery, 0.375. It has no impact on the rates on local sales taxes or any of the metro sales taxes. It will expand the base, which means the cities could actually pay off their projects sooner, which could save the taxpayers a lot of money in the long term.
Okay, Senator, we'll spend a few minutes on this. We do want to, we had hoped that this presentation would be over so that we could get to the 20 minutes of beginning testimony. It's likely that that timeframe is not going to work. But what we're going to, I'm going to propose as an alternative is those testifiers that have traveled a long distance and also there's one of the tribal chairs here. We're going to hear from him, and then whoever else will be asked to, that is usually around the Capitol. We'll have another hearing on testimony for the bill. But questions, Senator Drazkowski, or comments?
Thank you, Madam Chair. Commissioner, you said $8 of budget cuts per dollar of tax increases. Included in that calculation of $8 in budget cuts, does that include the hundreds of millions of dollars in shift to the counties?
Madam Chair and
Commissioner?
Senator Drazkowski, it did include the total amount, when you look at the budget, that were cuts, reductions in spending, which was about $1.9 billion. So it would include any impact on the counties, yes.
So Madam Chair, and
Senator Drazkowski?
thank you, and Commissioners, Commissioner, I don't think that's being honest with the people of Minnesota. When we claim that we're cutting the budget, or the governor claims that he's cutting the budget, and he's making the hard choices that are required in order to set priorities in this state, in reality, he's just shifting it to the counties. I don't think that's honest. I think that's dishonest to the people of Minnesota. Commissioner, line 16.24 of the bill, from the sales tax increases, this proposal exempts defined pension benefit defined benefit pension funds. Why is the management of those and the charges around those exempted where everything else is, everything in the private sector is charged? Why is that exception there?
Commissioner?
So, Madam Chair, Senator Driscollowski, so in looking at all of the exclusions that are in this are policy decisions. And so we just thought that area was one that the governor was willing to exclude. So it's just a policy decision. I'm not saying there's any, when we looked at those filing for the child tax credit and the working family credit, we absolutely do not want any obstacles in people, filing for those areas. So it's just policy decisions that were made.
So Madam Chair and Commissioner.
Senator Driscollowski?
Just a closing comment. If the governor is going to, in his proposal, increase taxes, increase the sales tax by $345 million in the planning biennium and $439 million increase in taxes in the out biennium, you would expect, and that's on largely the private sector of Minnesota. Why is it, and just rhetorically, Commissioner, I think we need to ask, why is it that this proposal brings forward a protection for those transactions that arrive out of government-managed funds? I don't think that's fair. Again, I don't think it's honest to the people of Minnesota. Thank you, Madam Chair.
Thank you, Senator Driscollowski. Anyone else? Then we'll go on to Article 4 very, very briefly.
Very good. Thank you, Madam Chair. So Article 4 here.
This is the
I closed my book here. Very
9
good. Landlord
sections of the
penalty for failure
miscellaneous
to submit
taxes, yes.
CRP. So because we're moving the renter's refund to a renter's credit, we're now requiring the CRPs to be electronically filed with the Department of Revenue. So it's $50 penalty if owners don't have that to the DOR by January 31st, and $50 if it's not to the renter by December 31st. Next one is reducing the sustainable force incentive payments. That's a 30% reduction. Part of this, and you had asked about this, Chair Rest, is that one part of it, there's a part currently in state law that says an increase or decrease can't go more than 10%. This does strike the part about the decrease on 10%, so it can go over that. And also, you may withdraw from the covenant by July 1st, 2026 without penalty as part of this proposal. Next, repeal local government cannabis aid. This very little has been paid on this, nothing to cities and very low amount to counties, and this is eliminated. Article 4 is repealing the tax filing modernization account. This was for a direct file. I will say that the Department of Revenue is still open to this. We just want to make sure that if the Department of Revenue does a direct file, we do it right, and that it's good for the taxpayer. And right now, there are some obstacles that create some real concern for the department. One is just the future of the direct file on the federal side, because the new Secretary of Treasury says he's committed to it this year, but he's going to study it into the future. And we can do it without being linked with the federal return, but it creates a lot more cost and security risks because we rely on the federal government really to do a lot of that initial looking for fraud and all those type of things. And then the second thing is ongoing funding. We don't want to start a program and then have to stop that. So members, that is the governor's, lieutenant governor's tax bill. Thank you so much, and looking forward and listening.
Thank you very much. I do want to get to the testimony, but Senator Weber, do you have a brief question?
I will gladly wait, Madam Chair, till the testifiers are done, and if we have to deal with it another day, I'm sure the Commissioner will be back. So.
Yes, indeed. Thank you, Commissioner.
Thank you, Madam Chair, members.
For the presentation. I'm very pleased to be offering 2374 on behalf of Governor Walz. We will now begin testimony, and would invite Shane Drift, the chairman of Voice for It, Band of Chippewa, to come to the witness table. Good morning, Mr. Chairman. Please identify yourself for the record, for the tape, and we welcome your testimony.
Okay. Yes, good morning, Madam Chair. My name is Shane Drift. I am the District 1 representative. I'm also the acting chairman for the Voice for It Band of Chippewa. I'd like to thank you for the opportunity to speak before you. With that, I will be talking about the proposed 30% cut for the CFA funding payments. If the cuts go through, this would severely harm our band's ability to repay debt from its land restoration purchase of over 28,000 plus acres of land that we purchased a few years ago. This funding is crucial to the band's financial stability. The band's annual CFA payment is the primary source for servicing the debt incurred from the land restoration effort. Cuts to this funding would force the band to reduce other critical government services to our band members. Landowners participating in the CFA program, including the band, enter binding contracts with the state of Minnesota for up to 50 years. The proposal undermines the stability and trust established by these contracts, which carry significant penalties for breach by landowners. The band urges the Walz administration and the Minnesota Legislature to consider severe consequences of the proposed payment reduction and to honor the state's financial commitments to the band, just as the band has honored its commitments to sustainable land management. Thank you for your time.
Thank you very much, Mr. Chairman. The next person is Mr. Rick Horton. Welcome to the committee. If you would identify yourself for the record.
Madam Chair and committee members, my name is Rick Horton. I represent the Minnesota Forest Industries. I would like to direct your attention to your packet. There's a coalition letter in there signed by a number of different entities ranging from conservation groups to forest products industry. And you will note Minnesota Environmental Partnership. I will say that when you have the forest products industry and the Sierra Club in agreement, you might want to take note. This program does require long-term commitments on the part of the landowners, 8, 20, and 50-year covenants on their land that transfer to future landowners, including family members. And what it does is restrict their ability to subdivide the land, develop on the land, and it requires them to have a sustainable forest management plan and follow that plan. And in return, on the state's part, there's a promise of an annual payment. And when this was established, well, I think it was when it was last sued over, which was in 2017, the language was added that this payment could not vary by more than 10%. And that was to give some stability and to ensure that future legislatures would not change this dramatically with the vagaries of a budget. And here we are. This bill strikes that language out, changes it to 30%, says that you can go below the 2017 level and go down to 70% of the 2017 level. This really, honestly, undermines agreements that landowners make with the state government. We do conservation easements, we have tax programs like this, we have 2C tax, we have all sorts of commitments that we make to landowners to try and encourage them to keep working for us working. and not see them subdivided, because that causes all sorts of other problems for local government to provide services when the cabins are built and things like that. This also runs really counter to a lot of the administration's climate change efforts. You know, we've got the we've got the Climate Action Framework, we've got the Department of Natural Resources, climate recommendations for forests, and all of them say, keep working forests working, keep them intact, and that's a big part of the climate change solutions, because trees absorb carbon and turn it into wood products, and it's the only carbon negative sector. So doing this will definitely result in some folks pulling out of.
Mr. Horton, I'm going to ask you to wrap up.
I understand. I would encourage you, read the testimony, and, you know, maybe I can come back at a future time. Thank you.
Members, we all have a packet of any number of letters here, and I encourage you to accept them as information and understand those letters as testimony. Next, Commissioner McDonald. And I would also ask Mr. Forrester if he would come to the table as well. We'll go right to him.
Madam Chair, rest and members, my name is Paul McDonald. I'm a St. Louis County Commissioner, and I reside, my district is in the heart of Lake Country in northeastern Minnesota. I'm here today to talk about two things, AIS prevention funding and also touch on cannabis aid. The proposed budget reduction would have a significant impact on the effectiveness of preventing or limiting the spread of AIS within St. Louis County and the entire state of Minnesota. The 50% proposed reduction will cost St. Louis County about $350,000 in 26 and 27. The biggest impact would be felt by our agencies and organizations who do the 25,000 watercraft inspections and also protect the 171 boat landings and nearly 1,500 trailer parking spaces. For over a decade, County AIS Prevention Fund is critical to preserving our lakes and rivers for future generations while supporting the fishing, boating, and outdoor recreation industries. Cuts to this program would jeopardize years of progress. This program works. Let's keep it. Madam Chair and members, I also want to talk a little bit about the proposed removal of the local cannabis aid, and this is disappointing to counties. The Senate stepped forward, this group stepped forward in 2023 to carve out a small sliver of the new sales tax. But that sliver is very meaningful to counties. And importantly, a recognition that our business registration duties, inspection, education, public health, and safety response come at a cost. We would be an outlier nationally if the state took this away, not providing local governments with a cent of any new revenue. I hope collectively we stand tall with the good position you took in 2023 as a body and make it clear that it's not okay to gut this new program. I want to thank the Tax Committee and Senator Hochschild for listening to county concerns and securing 10% for county revenue sharing. Appreciate the opportunity to speak today, Madam Chair. Thank you.
Thank you very much, Commissioner. Jeff Forrester, and then I'll also ask Ms. Gail Mikulich to come forward.
Good morning, Madam Chair and members
Forrester.
of the committee. My name is Jeff Forrester. Thank you for this opportunity to speak. I am the Executive Director of Minnesota Lakes and Rivers. We have over 300 Lake Association members representing about 60,000 lake home and cabin owners, anglers, resort owners, and others interested in Minnesota's lake and river heritage. In 2014, the legislature created what is known as the County AIS Prevention Aid. And this legislation has accomplished exactly what it set out to accomplish. If you look at this handout, you can see that this legislation literally bent the trend line on new infestations in Minnesota. Due to County AIS Prevention Aid, Minnesota has far better outcomes than neighboring states. And of the different AIS programs in Minnesota, the county AIS prevention aid is the most economical. The secret sauce that the legislature recognized in 2014 was Minnesotans. By directing AIS funding to local communities, we leveraged the passion Minnesotans have for our waters. According to a 2017 Concordia College study, lake associations contribute about 1.2 million volunteer hours of time towards protecting Minnesota's waters and donate over 6 million to lake and river management annually. County AIS Prevention Aid is an impact amplifier and has made Minnesota unique in our ability to prevent and manage the spread of aquatic invasive species. It generates innovation, provides boots on the ground, creates a fertile field for early adopters, and serves to engage and organize local civic infrastructure to protect our lakes. We strongly urge this committee to fully fund the county AIS Prevention Aid formula and to protect a remarkably powerful piece of environmental legislation to come out of the Taxes Committee. Thank you for this opportunity to speak.
Thank you very much, Mr. Forrester. Ms. Mikulich, if you'd identify yourself for the record.
Madam Chair, I'm Gail Mikulich, Chief Operating Officer for Northeast Bank in Minneapolis. Madam Chair and members, thank you for the opportunity to speak to the committee today on behalf of my bank and the Minnesota Bankers Association. Northeast Bank is a community bank based in Minneapolis with branches in New Brighton and Coon Rapids. It was established in 1947 by a handful of local business people who believed banking services were essential to the success of their community. We are concerned about Article 3, Section 1 of the bill, which expands the sales tax to additional services. Specifically, we are opposed to requiring banks to collect sales tax on certain bank fees. We believe this will have a negative impact on our customers and our communities. This amendment to the sales tax statutes is not a tax on services, it is a tax on fees. Some fees are for specific services and some are not. This bill does not make a distinction. This is not a tax on the wealthy, it is a tax on nearly every Minnesotan because banking is an essential service. According to the FDIC, 96% of U.S. households have a bank account. It's a big change to go from assessing sales tax on optional services to charging sales tax on a fee that is part of an essential service. Adding costs to bank customers could have the unintended consequence of keeping more lower-income Minnesotans out of the banking system. 1/3 of unbanked households cite fees or minimum balance as the main reason for not having an account. It may also encourage part-time Minnesota residents to move their deposits out of Minnesota, impacting the ability to make loans. If the state does charge sales tax on banking services, the legislature or the Department of Revenue will need to precisely define which banking services are taxable and which ones are not. The language in the current bill states that the tax applies to, quote, banking and brokerage services, including but not limited to 5 specific banking services. That language is far too ambiguous. Finally, the effective date of this section is September 30th, 2025. Banks need more time to comply with this new tax provision. Banking products and services are not currently taxable, so we do not have sales tax software programs connected to our bank's core processing systems. It will take time to acquire and implement the necessary software programs needed to comply with this new tax provision. Thank you again for allowing me to testify today.
Thank you, Ms. Mikulich. We are now going to delay the rest of this testimony until, is it Tuesday? Until next Tuesday. There being no further business before the committee, we are adjourned.